What if you could get a reliable paycheck every single month, straight from your investments? An income stream completely separate from your job, landing in your account like clockwork. Last month, my dividend portfolio paid me $1,252. It wasn't my biggest month, but it showed up without me having to lift a finger or sell a single share. This is the power of building a dividend paycheck. Now that number might seem huge or tiny depending on where you're at, but here's what really matters. I started from absolute zero, and in this video, I'm not just going to tell you it's possible, I'm going to give you the exact step-by-step playbook I used to build it. We'll cover everything from the right mindset to the exact investments I used, so you can get started building your own. Section 1. The problem and the plan. Let's be real for a second. The traditional path to financial security feels broken, doesn't it? You work a 9 to 5, stick some money in a savings account that pays you practically nothing, and just watch as inflation eats your savings for lunch. I was stuck in that same loop. I was saving money, but I wasn't getting ahead. My cash was just sitting there, losing value every single day. So, I looked into other things. I saw all the get-rich-quick schemes and the crazy volatile trades that promise you the world, but usually just deliver a world of stress. I quickly realized I'm not a trader. I didn't want the anxiety of staring at charts all day. What I wanted was a real second income stream, something that felt like a paycheck, not a lottery ticket. That's when I fell in love with the simple, powerful idea of dividend investing. But not just any dividend investing. I went all in on a specific strategy, building a portfolio designed from day one to pay me every single month. The goal wasn't to chase some explosive overnight growth, it was to create a consistent, reliable, and growing monthly income. That became my mission. To stop letting my money nap in a savings account and instead, put it to work to build an income machine, one dividend at a time. This video is that blueprint. Section 2, the blueprint. My step-by-step method. Step 1, the monthly paycheck. Mindset. The first and most important step had nothing to do with actually buying a stock, it was a mental shift. I stopped thinking like a stock market speculator and started thinking like a business owner. Think about it. When you own a share of a dividend-paying company, you are a part owner of that business, and when the business makes a profit, it sends you a thank you check for being an owner. That check is a dividend. My goal was to collect as many of these thank you checks as possible from a bunch of different businesses and set them up so they arrived every single month. Most stocks pay dividends quarterly, every 3 months. But a special group of investments pays out every single month. By focusing on these, or by carefully combining different quarterly paying stocks, you can create a smooth, predictable income flow. This is the heart of the monthly paycheck mindset. You're not just buying stocks, you're buying monthly income streams. Step 2. Finding the right investments, the how-to. So, how do you find these awesome monthly paying investments? They are more common than you'd think, especially in areas like real estate investment trusts, or REITs. These are companies that own and manage buildings that produce income, and they're often built to pass that income straight to shareholders. My search started with one of the most famous monthly dividend payers out there, Realty Income Corporation, ticker symbol O. This company literally trademarked the name, the Monthly Dividend Company, ER. You can't make this up. They own thousands of properties leased to reliable businesses like pharmacies and convenience stores. Their long history of not just paying, but increasing their dividend made them the perfect cornerstone for my portfolio. But you can't build a fortress on one stone. Diversification is everything. So I started looking for others, like EPR Properties, EPR, another monthly paying REIT that focuses on things like movie theaters and amusement parks. When I was checking out these companies, I wasn't just staring at the dividend. I was focused on 2 critical numbers. Dividend yield. This is the annual dividend payment divided by the stock's price. A 5% yield means for every $100 you invest, you get $5 back per year. Realty Income, for example, consistently offers a strong yield that often fluctuates around 5.5%. It's a great way to quickly compare income potential. Payout ratio. Honestly, this might be the most important number for safety. It tells you what percentage of a company's profits are being paid out as dividends, A super high payout ratio, especially over 100%, can be a giant red flag that the dividend isn't safe. I look for companies with healthy, manageable payout ratios that give them plenty of cash left over to grow the business. Finding the right stocks is all about balancing a good yield with a safe payout ratio and a long track record of reliability. Step 3. Building from scratch, the portfolio reveal. Alright, time to pull back the curtain. When I started, my portfolio was tiny. My first move was just a few $100s into realty income. And that first dividend I received, it was laughably small, maybe enough to buy a fancy coffee. But you know what? It was real. It was cash in my account that wasn't there before. Then, month after month, I stuck to 2 simple rules. I invested a set amount of money from my paycheck, and I immediately used it to buy more shares. Here's a quick look at how it grew. Months 1 to 6. I focused on building my base in realty income, and EPR properties, EPR. My monthly dividend income went from just a few bucks to about $25 a month. It felt slow, but it was happening. Months 7-18. I kept adding to those core positions and started to branch out. I added a monthly dividend ETF to get wider market exposure without having to pick individual stocks. My income crossed the $100 per month mark, which was a huge psychological win. It was no longer just coffee money, it was paying a real bill. Months 19 to 36. This is where the magic really started. My income was now big enough that the reinvested dividends themselves were buying a noticeable number of new shares each month. My income blew past $300, then $500 a month. The absolute key was consistency. Every single month, more money went in. Every single month, the dividends I got were put right back to work. Step 4. The power of DRIP, the automatic growth engine. Now, the secret weapon that puts this whole process into hyperdrive is something called a DRIP, which stands for Dividend Reinvestment Plan. Most major brokerages let you turn this on for free. Here's the easiest way to think about it. Imagine your dividend stocks are little apple trees. Every month, they drop some apples, your dividends. With a DRIP enabled, instead of just collecting the apples, you automatically plant every single apple, which then grows into a new, tiny apple tree. Over time, you don't just have your original trees, you have an entire orchard, and all of them are dropping apples for you. This is the power of compounding. When you automatically reinvest your dividends, those dividends start earning their own dividends. It creates an exponential growth curve that starts off slow, but eventually becomes an unstoppable force. My portfolio's growth wasn't just from the money I was adding, it was from the portfolio funding its own expansion. It is the single most important tool for turning a tiny stream of dividend income into a river. Section 3. A critical mistake I made now. I have to tell you about a huge mistake I made because I guarantee you'll be tempted to do the same thing. It's called yield chasing. When you first start, you see these stocks with eye-popping dividend yields. I stumbled upon companies like Armor Residential REIT, ARR, with a yield of over 17%, or AGNC Investment Corp, AGNC, with a yield over 14%. I thought I had found a cheat code to get rich 10 times faster. If a 5% yield was good, a 17% yield had to be incredible, right? Wrong. I threw some money into these and learned a hard lesson. An extreme yield is almost always a giant red flag for extreme risk. These companies can be incredibly sensitive to what's happening in the economy, and their dividends can disappear overnight. While I collected a few big payments, I also got hit with a dividend cut, which not only slashed my income, but also tanked the stock's price. The lesson was crystal clear. Sustainability is so much more important than a high starting yield. It's far better to own a solid company with a 5% yield that grows for the next 30 years, than a risky company with a 15% yield that gets cut next year. Now my portfolio is built on a foundation of reliable dividend payers. Don't let the dollar signs in your eyes blind you to the risk. Look, building a monthly dividend paycheck isn't about being some Wall Street genius or timing the market perfectly. It's about a simple mindset shift, being consistent, and having a little patience. It's about treating your investments like a business you are slowly building to work for you. The game plan is simple. Adopt that monthly paycheck mindset. Find good companies with safe, reliable dividends. Invest consistently, no matter how small you start. And turn on that drip to let the magic of compounding do the heavy lifting. It all starts with your first dollar and your first dividend. It might only be enough for a coffee, but that's how every great journey begins. Over time, that coffee money becomes a car payment, then a mortgage payment, and eventually, a source of real financial freedom. So now I have a question for you. What's the first monthly dividend stock you're thinking about adding to your portfolio? Let me know in the comments below. I read every single one.